Welcome to the Small Business Tax Savings Podcast, powered by Jetro. Each week, we bring extremely valuable accounting and tax tips specific to small business owners. You will be on your way to growing your business and putting more money in your pockets. Here's your host.
Hello and welcome back to another episode of the Small Business Tax Savings Podcast. This episode is brought to you by the Tax Minimization Program, which is a program that is meant to help you pay the least amount in taxes as legally possible while still giving you access to a full accounting team to ask general tax and accounting questions. I am your host, Mike Jesowshek, and today's topic is how do I pay myself as a business owner? Now, this is the 7th post in our Starting a Business series, and as we've kind of been talking about, this series stemmed from a conversation I had with a brand new business owner that was completely lost and really had no idea where to start in their business. And so I reached out to our Facebook group and said, hey, would you guys like a series where we go through all these different things that new business owners should know as they're getting into a business? And there was a big response that said, yes, we do want to hear that. And so that's where this Starting a Business series stemmed from. Now, if you haven't joined our free Facebook group, check it out now. Go to Facebook, type in Small Business Tax Secrets, answer a few questions. We'll let you in that free Facebook group, and you can collaborate with both our team as well as other business owners. So when I talk about that conversation I had with that new business owner, this topic today was actually the second question they asked. And for that reason, I knew it had to be a topic that I spent some time on. So many business owners get into business just kind of rushing in, they're starting to make money, and that's when all these questions start to occur. And one of the main ones that we hear, and especially this specific individual's first question was, how do I pay myself as a business owner? And so when you're looking to take money out of your business, it actually can be rather simple. Your entity type will help determine how you're going to actually pay yourself. But before we get into that, I wanted to list out some possible options. What are some ways that you can pay yourself in businesses? And then once we go through those, we're going to go through how they fit into your entity type, because only some of these payment options are only available to certain entity types. So the first way to pay yourself is an owner's draw or distribution. And this is simply the act of transferring money from the business bank account to your personal bank account. This could be in the form of writing a check, doing an internal transfer at the bank, taking cash out, etc. Simply put, it is just taking business funds and moving them to you personally. The second way you can pay yourself is payroll. And as we've talked about a few episodes ago, we recommend doing payroll through an actual payroll software. The software that we recommended a few episodes was called Gusto. And if you haven't listened to that episode, go back and check it out. But the act of payroll requires you to have payroll tax withholding, tax form filings on a regular basis, and regular payments to various government agencies. And that's why we recommend using a payroll software. Payroll software can really simplify all of that back office type work. The next way you can pay yourself is through a guaranteed payment. And these are usually part of a partnership agreement, and our payment is really a payment that is agreed upon that is guaranteed to a specific partner in the business, regardless of the profit or loss of the business. This is not tied to a percentage of profit or anything like that. It's a payment that's guaranteed regardless of how the business performs. Finally, a dividend, and these are more rare and they work similar to an owner's draw distribution, but oftentimes requires some extra year-end paperwork. So when we look at how do you pay yourself as a business owner, there's 4 main options: an owner's draw or distribution, payroll, a guaranteed payment, or a dividend. Now we want to talk about, based on the entity type that you are, how should you pay yourself? Because not all of these types are available to every type of entity type. So let's look at entity type that you're organized as. If you're organized as a sole proprietorship or a single member LLC, you're going to pay yourself via an owner's draw. And this is a fun fact, you are actually not allowed by law to pay yourself via payroll. So if you're set up as a sole proprietor or single member LLC, you're going to pay yourself via an owner's draw. If you're set up as a partnership, you're going to either pay yourself as an owner's draw and or a guaranteed payment. Here again, you are not allowed by law to pay yourself via payroll in a partnership. Now, if you have employees that are not owners, those can be payroll, of course, but the owners are not allowed to receive payment via payroll. If you're set up as an S corporation, you're going to pay yourself by both a distribution and payroll. Now, remember when we talked about the advantages of an S corp, and we mentioned that you are required to take a reasonable salary. But we talked about how that only makes up a part of your income. The rest of your income comes in the form of distributions. So with an S corporation, you're doing both a distribution and payroll. And finally, for a C corporation, you would pay yourself via a dividend, and more likely than not, you're also going to pay yourself with a salary. So a dividend and salary combination. So again, if you're a sole prop, you're paying yourself via an owner's draw. If single member LLC, you're paying yourself via an owner's draw. If you're a partnership, you're going to pay yourself via an owner's draw and or a guaranteed payment. If you're an S corporation, you're going to pay yourself via payroll and a distribution. We're going to split your income into two. Some of it's going to be via payroll. Some of it's going to be via a distribution. And if you're a C corporation, you're going to be likely receiving both dividends and potentially a salary as well. So now we kind of know these types of items. Let's go through how taxes are handled in each of the different payment options, because this is a key thing too. They say, okay, great, I'm paying myself, but now how the heck do taxes work? So we're going to break down how taxes work for each of the payment options. Let's start with owner's draw or distributions. And here I'm going to get a little geeky, and because I take this one, I won't put a heavy emphasis on this one because people often get misunderstood on these owner's draws. An owner's draw or distribution is not taxed directly. So if you transfer $50,000 from your business to your personal account, you'll receive $50,000. There's no taxes that need to be taken out on that transfer. However, with that being said, these are also not considered expenses to the business, and thus you're going to end up paying taxes on it at some point when you recognize the higher income that the business had because there was no reduction in it when the owner's draw went through. So let's look at a quick simplified example. Let's say you had a starting bank balance of $0. You had profit of $85,000, so you had business expenses, whatever was left over, profit before paying yourself was $85,000, and then you took a distribution to yourself of $50,000. Your ending bank balance in that case would be 85 minus 50, which is $35,000. So in this example, you have only $35,000 left in your business bank account. However, you would still have a profit of $85,000 because that $50,000 draw or distribution you took was not an expense to the business. Now, when you go to file your taxes at year end, you'll be paying taxes on that full $85,000, the profit of the business. So in other words, you still technically pay taxes on draws or distributions. They just do not need to be withheld when making the actual payment to the owner. And this is where estimated taxes become so important. Understanding what type of taxes we need to send into the government as an estimate of what our tax bill is going to be throughout the year. Because otherwise you get stuck, and we kind of talked about this in last episode, you get to the end of the year, have this big tax bill, and surprise, surprise, you maybe don't have cash available for it because you didn't understand that owner draw that you were taking, that money you were taking out of the business, you had to still pay taxes on because it wasn't a business expense. All right, let's look at payroll. So payroll, this is a business expense. So unlike draws or distributions, it actually does reduce your business income. However, since it's payroll, and when you take it as an owner of the business, it's going to turn into new taxable income to you because it's going to be in the form of W-2 income. So you will get a business deduction, but it's going to turn into W-2 taxable income to you in the form of payroll. Now, if you're using a payroll software, you would have filled out a W-4 when you first onboarded as an employee of your own business. And that W-4 tells the payroll software how much in taxes to withhold from your payment. So this means that when you process the salary via payroll, you'll have a gross amount, and this is going to be the pre-tax amount you earned. So let's say it's gross of $50,000, but you're only going to receive a net amount, which is what it is after taxes have been taken out, which the payroll company will take care of sending to the government agencies. So you're going to have a gross amount. The payroll software is going to take taxes out, send them to the government agencies, and then you're just going to receive a net amount, whatever was left over after taxes. Okay, let's talk about guaranteed payments. These are a combination between draws and payroll. With a guaranteed payment, it is an expense to the business. However, the partner that received that guaranteed payment gets it added back to their income where they're eventually going to pay taxes on it. And guaranteed payments work similar to draws, where there's no tax withheld when making the payment to the partner. And we also highly recommend estimated taxes for that partner that's receiving that guaranteed payment. Dividends, these are less common for your typical small business owner, and they get taxed at different rates depending on if it's a qualified or non-qualified dividend. So again, let's kind of walk through that. Owner's draws or distributions, they're not taxed directly. So when you do the transfer, you don't have to withhold taxes or anything like that. But these also do not reduce your business income. So oftentimes people come to us, they have $0 in the bank at the end of the year, and they say, Mike, how did I make any profit? And it's because that donor's distribution, that money that you took out to pay yourself personally, was not a business expense. With payroll, these are expenses to the business, but as the owner, you're still gonna, it's just gonna turn into a different type of taxable income to you. But the payroll software takes care of taking taxes out and things like that for you. In guaranteed payments, they are an expense to the business, but then the partner that got the guaranteed payment, it gets added back to their income. And again, works similar to a draw where there's no taxes withheld when making the actual payment, but works similar to payroll where you do have an expense to the business when you're making them. And then finally, dividends. These are just going to depend if it's qualified or non-qualified. All right, so what else do you need to know about paying yourself? First things first, the most common types of small business owners that we see are sole proprietorships or single member LLCs or S corporations, which means everything we talked about today you don't need to worry about except for draws and or a salary if you're an S corporation. Second, taking an owner's draw is actually very simple. Do not overcomplicate this. This is where we see people get so frustrated about, how do I take money out of the business? I don't get it. Don't overcomplicate this. Simply take money from your business account and put it in your personal account. That is the act of an owner's draw. Taking money from your business account and putting it in your personal account. Third, if you need money personally, always transfer it first to your personal account and then spend it. Do not start paying for personal items out of your business bank account. Transfer it from your business account to your personal account and then do whatever you need to do personally for it. And finally, remember, if you operate as a sole proprietorship, a single member LLC, or a partnership, you are not legally allowed to pay yourself as an owner via payroll. So I just want to kind of walk through again these options. How do you pay yourself as a business owner? The options available are owner draws or distributions. And again, this is simply the act of transferring money from your business bank account to your personal bank account. You can pay yourself, or another option is payroll. And this is where we kind of recommend using a payroll software. With payroll, you have payroll tax withholdings, you have payroll tax form filings, various payments that need to go to government agencies, and a lot of paperwork, which is why we recommend a payroll software. Another option is guaranteed payments. These are usually part of a partnership agreement and agreed upon ahead of time. They're not subject to depend on profit or income of the business. And then finally, dividends, which are a little bit more rare. Now, which are we working with? So depending on the type of entity type you have is going to depend on how you pay yourself. If you're a sole proprietorship or a single member LLC, you're going to pay yourself via an owner's draw. You cannot do payroll. If you're a partnership, you're going to pay yourself via an owner's draw and or guaranteed payment. If you're set up as an S corporation, you're going to pay yourself both as a distribution and payroll. So remember, you're going to take that reasonable salary, which is going to be part of your income, and any income you make over and above whatever that reasonable salary is, you're going to take in the form of distribution, simply transferring money from your business account to your personal account. And then finally, if you're set up as a C corporation, you're going to likely pay yourself via dividend and potentially a salary. And then how are taxes handled on these? So an owner's draw, again, not an expense to the business, so it does not reduce your taxable income of the business. But there doesn't have to be any money withheld when you're doing that actual transfer. You're just taking the amount, moving it from the business to your personal. No taxes have to be withheld then, but just know you are going to have to pay taxes on that at some point because that is not an expense to the business, and thus it will not reduce your business income, which is what you get taxed on. Payroll is an expense of the business, but the person receiving the payroll just turns into W-2 payroll instead. So it is an expense. It does show up on the income statement, but you're still going to show income on that on your personal side. And we highly recommend with Payroll to use a payroll software. With Payroll, taxes are withheld from your paychecks. You're going to have a gross amount. This is the amount that you got paid prior to taxes being taken out. The payroll software is going to withhold taxes, and then you're going to receive the net, whatever is left over. Guaranteed payments are an expense to the business, and then the actual payment, the partner that's receiving that payment, it'll be added back to their income. No taxes need to be withheld on the actual payment, but know that the partner that is receiving that will still have to pay tax on that because it will show up on their item. For owner's draw and distributions, guaranteed payments, things like that, we highly recommend doing estimated taxes, which we're going to be talking about in a future episode. And again, dividends, they're going to be taxed at different rates depending on if they're qualified or non-qualified dividend. So again, sole props for single member LLCs or S corporations, you're going to be worrying about draws and salaries. Salaries for S corporations only. Sole props and single member LLCs, you're going to be worrying about draws only. Taking an owner's draw is very simple. Just don't overcomplicate it. Transfer money from business account to personal account. And we've talked about this in the past always. If you need money personally, always transfer it to your personal account first and then do the spending on it. Don't do personal spending on your business bank account. So hopefully this was helpful, and now you're going to have no problem kind of understanding how you're going to get paid from your business. This is important. As a business owner, as you're going down this journey, paying yourself, getting that cash as you're starting to make money is a really big thing and important thing. So again, hopefully you found that helpful. Finally, I want to recommend our tax minimization program. We talked about it a little bit at the beginning, but our tax minimization program includes our stress-free bookkeeping training as well. So not only are you going to get a bunch of in-depth training, templates, monthly group coaching, but you also have unlimited access to our team for general tax and accounting questions. So with this program, you have access to our team for those general questions. How sweet would it be to have an accounting professional by your side for those questions that pop up along the way of this crazy journey of being an entrepreneur? So check out our tax minimization program. You can find it at taxsavingspodcast.com/tax. That's taxsavingspodcast.com/tax. I want to thank you for listening to another episode. We're going to continue this series on starting a business that we're talking about. We're going to continue this path along different things that we want business owners as they're just getting started to know about. So if you have questions, join our Facebook group, let us know, and I will see you next week.
This has been another episode of the Small Business Tax Savings Podcast from the team at Jetro. If you enjoy our weekly episodes, please leave a review on whatever platform you listen to us on and share with other business owners. If you have any questions or future topics you want to hear, email them to tax@jetrotax.com. Thanks for listening and have a great day.